Gold's Asian market price dominance continues. The gold buying frenzy out of China in particular that drove gold from $3,000 to $3,500 an ounce when President Trump imposed the exclusionary tariffs of 145% has now abated following the negotiation of only a 30% tariff on China for their exports to the United States for the next 90 days. So gold is easing a bit. In this gold market commentary for May 16th, 2025, I'm going to explain to you the details underneath all of the gyrations that we've seen in the last couple of weeks. We'll go over what's happening with the US economy, which is clearly weakening a bit further. We're seeing bond yields rise a bit, which is not very good, especially when our debt ceiling is about to be raised. And we'll give you support levels for gold, both for support and resistance, and for silver as well. Hi, I'm Dana Samuelson, president of American Gold Exchange in Austin, Texas. We're a national, physical, precious metals dealing in modern bullion and vintage US gold and European gold coins. If we can help you with any of your needs in the physical arena, we'd love to have that opportunity. In our last gold market commentary, I detailed how the $519 gold rise from April 9th to April 22nd was driven primarily during overnight Asian market trading hours. I drilled down a little bit more tightly on those trading hours and discovered that my last update, where I said 76% of gold's $519 gain for $395 was Asian market driven. Well, it was actually more than that. It was 84% or $442 of that $519 gain. But now we're seeing Asian market dominance continue only the other way, with the gold price easing with the easing of tariffs. This is a chart of the June gold COMEX contract from noon on May 4th to noon on Monday, May 12th. And in particular, on Sunday evening, May 11th, following the announcement of the reduction of tariffs in earnest from 145% to 30% on China by the US, and China reciprocating by dropping U.S. tariffs from 125% to 10%. Following that announcement in Switzerland on Sunday, May 11th, gold gapped down $45 on the Asian market open following that easing of tariffs. In addition to that, gold continued to fall as the Shanghai trading session transitioned into the London trading session, with gold dropping for a total of $130 in that single period of time before the New York market opened. But it was led by a big gap down starting in the Asian markets, which shows you how the Asian markets continue to dominate gold price action over the US market price action. Since then, we've gone primarily sideways, with gold trading in about a 32.50 to a 31.75 range, and we'll drill down on that a bit more in just a moment. This is a chart from the World Gold Council. We just got it, that shows how much gold ETF inflows occurred in China for the month of April, and they were really sharp. You can see off the charts for what they've done over the last 3 years, multiples. And this is an indication of all that gold buying that occurred in China because of the imposition of tariffs. Now, if you're China and the US is your biggest customer, and we suddenly impose what are exclusionary export tariffs of 145%, which means no one's going to buy your product. Well, what do? If you're a Chinese investor and you want safety, you buy gold. Well, they did that in earnest in April. And now that's easing a bit because we've got tariffs at a more reasonable level. But there's bigger things afoot with regard to gold and China. This is an article that was on Reuters from May 8th. China loosens gold import quotas with an eye on arresting the yuan rally. So what's happened is Chinese investors and the government have fled U.S. treasuries or U.S. markets and the U.S. dollar, and they've bought back into their own Chinese markets, brought the money home, they've pushed the yuan up. But what China's central bank is now doing, it's allowing foreign exchange purchases by some commercial banks to pay for gold imports under recently increased gold quotas. That allows these commercial banks to sell the yuan, to push it down, and to help buy gold with that, with the dollars that they buy, pushing the yuan down. So the Chinese are using gold as a way to regulate the value of their currency and hold its current rise in check as some of this money repatriates. And this is a big deal. It could help lenders meet significantly increased appetite for gold while slowing the pace of the yuan appreciation. If they're exporters, and that's what China is, an exporter of goods, and the value of the yuan rises, it makes the cost of their goods more expensive everywhere they ship. And with the US imposing exclusionary tariffs, China has increased their shipments of goods to other places, which is one of the things I told you would happen when you impose much higher tariffs on people all of a sudden. First of all, they're going to want to negotiate for lower tariffs, and we've seen that. And secondly, they're going to want to find new customers. Well, in this case, they are increasing their sales elsewhere, specifically in India, in Southeast Asia, and in Europe as well. So the Chinese are encouraging the public, which they've been doing for years anyway, to buy gold to help hold the yuan in check. And on top of that, despite higher gold prices, Chinese central bank also increased their gold reserves for the sixth straight month in April. And this is just more reason why China will continue to dominate the gold price activity going forward. Meanwhile, back in the US, President Trump's big, beautiful bill is being crafted in the House and the Senate. And part of that bill is to increase the US debt ceiling by $4 trillion, maybe $5 trillion if the Senate gets their way. So the US debt is about to go up another 10% as part of President Trump's three-pronged strategy of tariffs, tax cuts, which the raising the debt ceiling is going to help to pay for in the short term, and deregulation. So we're going to see the US debt jump as the debt ceiling is lifted $4 to $5 trillion. And US debt has been out of control over the last 20, 25 years. In 2004, our debt was $7 trillion. By 2014, 10 years later, we had more than doubled that, $17 trillion. 10 years later, in 2024, we doubled that again to 34 trillion. Today, we're at about 36.5 trillion. And now we're saying we're going to increase our debt ceiling limit $4 trillion, maybe $5 trillion, to over $40 trillion. This is not good for the US. And it's one of the things that President Trump is trying to alleviate. And this is a bit of a conundrum for me to reconcile. Increasing our debt to give tax cuts, to spur economic activity. I'm not sure we're going to get there, to be honest with you. We'll see. What we are seeing is inflation coming down, which is good for the US consumer. The consumer price index has now dropped 0.7% in just the last 3 months alone, bringing the headline CPI down from 3% in January to 2.3% in April, and approaching the Fed's 2% inflation target, still a little bit above it. We've also seen producer prices tumble in April, 0.5 point. And it's thought that the producer price index is a bit more sensitive in real time to what the market can really bear, because producer prices are what producers get when they manufacture goods and want to sell them immediately into the marketplace, while the consumer price index has a bit of a lag, depending upon whether consumers accept that price from a producer or not. So this is thought to be a bit more immediate measure of the strength or weakness of the US economy. But the reason producer prices have fallen and tumbled over the last month are not good. It's because of a margin squeeze. Producers are not able to pass through some of the cost inputs that they're now receiving from their raw materials into their finished goods. So their margins are being squeezed. And in that excellent interview I did with Danielle DiMartino Booth of about a month ago, Danielle described the situation back then as companies are being squeezed in their margin, the amount of profit they earn on the products that they sell. And on top of that, Danielle explained that the top line revenue or gross sales figures for a lot of companies are falling as well. So they've got weaker sales, which are translating into tighter margins, lowering of their prices to try and spur sales. This is another indication of a weakening US economy. And in order to cut costs, the most effective way to lower the cost that the business has is to cut employees. And in that interview, Danielle said she thought our current unemployment rate of 4.3% could go as high as 4.9% in September, which means she anticipates the US economy to take a real tumble over the next 3 to 6 months. And I heard an interview with one of the most respected economists in the country today, Anna Wong from Bloomberg, who is indicating similar projections from her economic analysis. She thinks that the unemployment rate could hit 4.8% by December. So both of these analysts think that we're going to see substantially higher unemployment sometime between September and the end of the year. And that's not good for the US economy because the consumer is 70% of our economy. And we're not only seeing margins being squeezed, we're seeing retail sales fall as a result. And specifically, this is another article from Bloomberg that says US retail sales barely rise in April, suggesting some spending pullback. But this is a bit lumpy because of tariff front running. So we'll give this one a pass for right now. But it's possible that we could see the US consumer start to really hunker down as the cost increases from tariffs finally start to actually hit the US economy. And this is where the rubber meets the road. My concern all along is that the US consumer is not going to be able to stomach the pain that we're going to go through, which is going to start now in earnest with higher cost inputs from these tariffs before we attain the gain that he's trying to accomplish with his three-pronged strategy of tariffs, tax cuts, and deregulation. Walmart announced just the other day that they were going to have a hard time absorbing higher costs without passing those on to consumers. And this is what I mean by pain. The company said that US tariffs on imported goods will push prices higher. Chief Executive Doug McMillon said cost pressures from all tariff-impacted markets started in late April and accelerated in May. Now they're going to start really showing up on our shelves and in our economic data. McMillon went on to further state, we aren't able to absorb all the pressures given the reality of the narrow retail margins. And Walmart works on really tight margins. So they're going to be forced to pass some of those cost inputs through to the public. And that's what I mean by pain. And we're on the verge of it right now. And we're seeing an unusual reaction in the bond market. We're seeing yields on the 2-year and the 10-year treasuries rise, popping after the Fed held rates in check at the conclusion of their last meeting on May 7th, which was expected. But we have seen inflation come down since then. Employment's steady, but the economy is looking weak, which would give Chairman Powell a reason to cut rates in the future. But we're seeing the market say, hey, hold on a second. If we're going to invest in US treasuries, we want a higher return for the risk that we're going to take to do so. So the market is asking for a higher return of rate of interest. And both of these levels have risen above where they were on tariff turmoil day, April 9th. Now the market is saying, hey, we want a bit more for our money. Now, it's not unusual with the Fed holding rates steady that we would see the 2-year treasury hold steady, but it's gone up. So the market thinks that we're not going to get the number of Fed funds rate cuts this year that they were betting on just a couple of weeks ago. And Chairman Powell is specifically concerned about the impulse, the inflation impulse that tariffs are going to push into the US economy over the next couple of months. In their dual mandate for price stability, which they have no control over right now, or unemployment, which they modestly do with their federal funds rate. But I think the Fed is going to prove to be found to be committing another policy error and to be behind the curve yet again by not adapting to the fact that we're in a real margin squeeze for corporations, which is going to lead to a real reduction of employment. I think that's pretty baked into the cake right now. And you can see how bond yields have popped following the announcement that the Congress was going to raise the debt ceiling limit $4 trillion. The 10-year Treasury yield popped about 50 basis points, 40 basis points as a result of that. So that's investors wanting more for the risk that they're taking. And we're seeing the dollar bounce a little bit too, with the Fed holding rates higher. But this is a bit of a dead cat bounce as far as I can see on the dollar index, which is sold a little too far, too fast on the way down, with it hitting 98.28 at the bottom. It's rebounded up to about 101.8, but now it's settling more into a range between 101.8 and 100.5. I do think we'll see the downward trend resume in the coming month or two as consumer spending continues to decrease because of higher costs and corporations really start to feel the pinch in margins, which will lead to layoffs. So I do think the dollar will decline further from here, and that's good for gold. You can see the rebound that the dollar has gone under on the 6-month candlestick chart since bottoming. It's been a modest grind higher, not a real sharp rebound. And it still has yet to get over the major downward trend line that would be there if I had drawn it in on the chart. So I think the dollar is probably a little bit overbought at this point in time, and we'll start to see it edge back lower from here, which will be good for gold. Moving on to gold, onto the 1-year gold chart, you can see gold's gained 32% now over the last 12 months, but it has gone into a corrective phase after topping on a daily close basis at 34.34 on April 21st. Now we're going down with lower high and lower lows just in the last couple of sessions. Right now, I see support for gold at 31.75. We're a little bit over that in today's trading session at around 3,200 right now. I see a lot of support for gold in increments below here at 31.50. And again at 30.50 and especially at 3,000. So I don't think gold is going to get that much cheaper for a whole host of reasons, which is, demand for gold around the world due to our tariff policy, creating a lack of trust in the U.S. I do think the dollar will weaken, and I think the economy will weaken. And I think if the Fed is really forced to cut rates in earnest, that'll only help to buoy gold too. So I don't think gold has too much more downside from here, but it could leak a little bit further over the next couple of weeks. On a 6-month candlestick basis, you can see that this is a really, really busy chart, but I've indicated where the U.S. and Chinese tariffs helped to push gold lower once they were negotiated lower, not only from, hey, we're going to do it, to, hey, we have done it, as labeled by number 4 on this chart. So I see gold hitting support at 31.75. Again, we're a little bit above that today as I tape this, with upward resistance at 33.50 and a lot of support again at 31.50, 30.50, and 3,000 on the way down. So gold is in a bit of an easing consolidation phase right now that I don't think will last too long or be too extreme. Silver is trending mostly sideways after some knee jerks around Liberation Day in early April. It's been trading primarily between $32 an ounce and $33.50, and it remains in that range today at about 32.30, 32 and a quarter. You can see that the trend on the 6-month candlestick chart, however, is for a little bit lower. The highs over the last 2 weeks have been lower, while the bottom has held. And this is a pinching formation that could lead it to leak a little bit further. But I do think silver is a good buy, especially under $33 right now. Anything under 32 is going to look very attractive to a lot of people, in my opinion. And we have seen the gold to silver ratio narrow over the last 2 weeks as the gold price has eased more on a percentage basis than silver has, bringing the ratio down from over 101 to just under 99 to 1 today. I think we could see this ratio narrow just a little bit further, but silver remains decidedly undervalued relative to gold today, especially as you measure it on the gold to silver ratio chart. And in physical specials, we've got two specials in the marketplace right now. We continue to have backdate 1 ounce US gold eagles available at $50 off of our regular pricing while supplies last, bringing them to one of the lowest prices in the country right now. And in silver, we have 2025 dated 1 ounce Canadian silver maple leafs featuring King Charles as low as $2.99 over spot, which I do think is the lowest price in the country today on Canadian silver maple leafs. And these are all minty fresh. That's our update. Thank you so much for your time. Thank you to all our clients for the loyalty and trust that you've placed in us over the last 27 years. Without you, we wouldn't have a business, and we are grateful for that every single day. So thank you so much. Have a great week.